This is Bloomberg Intelligence.
We're really getting into now the streaming's arms race.
Dish is looking at that and saying we can really build a nice niche for ourselves.
In-depth research and data on 2,000 companies and 130 industries.
The dollar is the dominant currency in the planet.
I think the acquisition is a natural progression of what Microsoft can do with this technology going forward.
Bloomberg Intelligence with Alex Steele and Paul Sweeney on Bloomberg Radio.
Over the next hour, we are going to dig inside the big business stories impacting Wall Street and the global markets.
Each and every week, we provide in-depth research and data on some of the 2,000 companies and 130 industries our analysts cover worldwide.
Today, we're going to take a look at banks as credit indicators suggest weaker results ahead.
Plus, the adoption of ChatGPT is big with Gen Z, but payment for it, not so much.
But first, we want to turn to the tech-savvy payment processors like Stripe or Adyen, which could disrupt the more dominant traditional payment companies in the near future. So for more on this, we're joined by Bloomberg Intelligence senior financials analyst Diksha, Gera. First of all, what is Stripe, Adyen? What do these companies actually do?
They're kind of, think of them as part of the supply chain within a payments processing cycle. So these companies are what they call issuer processors and merchant processors. An issuer processor is responsible for either declining or approving a debit or a credit card transaction on behalf of the card issuer. So say, for example, Chase is the card issuer, but the processor actually approves or declines, as well as settling transactions, maintaining the system of records for cardholder data. Some of the banks do this part themselves, but most of the banks outsource. So think of them as the back end for the issuer.
All right, so if I'm representative of the world in terms of my banking, my personal banking, I do a ton more digitally now than I did pre-pandemic. Talk to us about how that all works. Who are the players in this system? When I make a digital payment, or I go just kind of put my phone against the subway reader and I hop on the subway, how does that work today, and how may that change going forward?
Yeah, so if you look at when you go and swipe a card, there's a POS machine that you do that on, or you do that on your mobile phone. The processor is the one that actually, the merchant processor, the acquirer processor is the first point of interaction for you when you swipe that card. This is the person who basically connects you to the card network, to the acquiring bank. It processes the payment, and that business is a scale business. The other participants in that ecosystem are the card network themselves and the banks that are issuing the card. But if you place these companies like Adyen, Stripe, Marqeta, these are relatively modern processors. And what has happened is, to your point, the landscape has changed. Just the landscape of banking has changed. Traditionally, it was mostly the banks that were issuing credit cards, right? These banks largely worked with the legacy processors because of the breadth and the reliability of their offerings. Transactions will go through. They can handle that level of volume. But over the last 5-10 years, what we've seen is a lot of non-banking companies have come to market. If you look at the likes of Cash App and Chime and a lot of retail and airlines companies, Amazon, Uber, Apple, these companies are issuing their own credit cards and debit cards. And we are not talking about cards that work only on their stores or only on their apps. We're talking about open-ended Visa and MasterCard and American Express cards that you can just use how you use your Chase Sapphires or American Express Platinums. So a lot of people wonder why these companies are getting into card issuing. And there are a lot of reasons, but the most generic one is that these tech firms want to integrate payments within their core offerings. They increasingly see this as an extension of their overall customer experience, the engagement, loyalty, and they want more fast, agile solutions for that.
So did the processors get bought by a big bank then to make this more efficient, or do they team up and then scale up? How does this evolve?
So it's a very interesting question, Alex. We've seen a massive land grab and expansion along the payment supply chain. Most notable ones were the 3 large processor mergers that happened in 2019, where Global Payments and TSYS merged, Fiserv and First Data, and FIS and WorldPay, they all merged. By the way, FIS and WorldPay are now going to split apart. But I think the idea is that since both these businesses of merchant processing and issuer processing are scale businesses, they were trying to build that scale that some of these modern tech processors build via technology. The way a modern tech-first processor scales is very different from the way a legacy system scales. So what they've done is they've gone out and bought those capabilities. They've bought those scales. But the issue with that is still that when you're going out and competing with like more e-commerce linked businesses, the agility that is expected is what is something that the legacy companies will have to kind of deal with. And again, like you're right, these companies are not sitting quiet. They are going about with acquisitions, and then they're building capabilities within the fastest growing segments within payments, like vertical software payments, and like WorldPay is eyeing global e-commerce. So say, for example, Google wants to launch in 10 new countries. They are probably going to be the only game in town other than Adyen. So we are seeing some level of consolidation, and I think we will keep seeing that. But it's a very, very interesting and a landscape change, and we're watching it very closely.
Really, really interesting. Diksha, thanks so much. Diksha Gera, a Bloomberg Intelligence Senior Financials Analyst. We appreciate it.
All right, let's turn now to the UK housing market, where a hot rental market drives first-time buyer demand despite sentiment around further rate hikes. For more, we're joined by Bloomberg Intelligence equity research analyst Iwona Hovenko. Iwona, thanks so much for joining us here. Just give us a kind of snapshot of what the UK housing market is like here right now.
Yeah, so despite lots of very gloomy predictions, the UK housing market has been improving this year, and it has surprised a lot of people, including myself, and I was actually one of the more positive voices out there. And what's driving the market is actually buyers surprisingly very quickly got used to the rates that are now, actually they're not as high as they were late last year. They're oscillating actually around 4%. And what's been most surprising is actually it's the first-time buyer who came back most strongly. And like you just said, it's the very competitive housing market, especially so in London, and fast-rising rents, large competition, and actually, unfortunately, and this is proven by the English Housing Survey, unfortunately, the private rental homes are the worst quality type of tenure in the UK, so lots of push for the buyers to actually own their own home.
So here in the U.S., what we see is that new home sales doing really well because existing home sales are like non-existent because no one really wants to sell. And that makes it look like demand is super strong for new home sales, which may be true, but it's also being a bit distorted. What's the situation like in the U.K.?
So with the UK, it's a slightly different story because obviously in the U.S. you have your famous 30-year mortgages, so no one wants to remortgage at a much higher rate.
We love them. We love them.
Yeah, so we don't have that. We only have our 2-5. Some people are lucky enough to have fixed on a 10 years at 2%. So it's slightly different. So this year, unfortunately, I don't expect for the home builders, their volumes are likely to fall steeply simply because they lack the confidence to actually go ahead with major projects with prices are not falling, but they're actually muted. And at the same time, we still have build cost inflation around 10% for a lot of them.
So talk to us about the geographic differences you may be seeing in the UK. Is it kind of London and the South stronger than maybe the rest, or kind of what are you seeing?
It's a bit diverse, and actually, ironically, it's the regions that are more affordable, which are up north, that have been more resilient because earnings multiples you need to buy a house are so much lower. In London, we're looking at 13 times earnings, and in up north, you might be looking closer to like 5 times. So this is for a single income person. So actually, the more affordable regions are doing better, especially as they're also popular with buy-to-let investors because the yields are so much higher there.
So in terms of, say, companies, are we looking at the home builders that we need to be looking at and what's already priced in? I mean, here, for example, Toll Brothers has had an incredible run so far.
Yeah, so home builders are actually, right now the expectations are for a pretty tough 2023. Volumes to fall, for example, for Persimmon, who's very focused on first-time buyers, it's actually the expectations are for volume to fall around 30%. It's ironic given what we talked about first-time buyers being backed very strongly, but it's also because new homes are actually command about a 15 to 20% premium, and we've just lost Help to Buy, which was an incentive program for new homes.
Right.
So now buyers basically may actually prefer to go for existing homes because they're so much cheaper.
You know, here in the U.S., Iwona, you know, they're building lots of homes, but they're not building a lot of starter homes for first-time buyers, you know, because the profit margin is in with the big McMansion houses that you can sell for a higher price and higher margin. What are you finding in the UK about new home construction?
So actually, I would say that there is a bit more focus on those kind of more basic homes. We don't have those Mac mansions, and actually that would be much more niche market. So it's the first, second steppers. Some home builders might have a bit more of those bigger homes, but it's actually starter homes. For a lot of the home builders, they had a vast chunk of their buyers would be actually first-time buyers. So I think they were saying in high 30s. Of the completions that they've had are around that sort of share, 36, 38% are first-time buyers.
Interesting. Iwona, thank you so much. Iwona Hovenko, Bloomberg Intelligence Equity Research Analyst. We appreciate that.
Coming up on the program, we talk ChatGPT and growing interest from Gen Z.
And you're listening to Bloomberg Intelligence on Bloomberg Radio, providing in-depth research and data on 2,000 companies and 130 industries. You can access Bloomberg Intelligence through BI Go on the terminal. I'm Alex Steele.
And I'm Paul Sweeney. This is Bloomberg.
You're listening to the Bloomberg Intelligence Podcast. Catch us Saturdays at noon Eastern on Bloomberg.com, the iHeartRadio app, and the Bloomberg Business app, or listen on demand wherever you get your podcasts.
The use of generative AI tools is skewed towards 16 to 34-year-olds, suggesting adoption of the tool is poised to expand. However, payment for the service may be an afterthought. We're joined now by Bloomberg Intelligence Senior Technology Analyst Mandeep Singh for more. Generative AI, can you define that for like 99.9% of the world?
Well, so this is an extension of machine learning and AI where you can feed an algorithm with large amounts of data, but it can generate new data for you. So far, machine learning was used just for recommending stuff. Okay, these are my browsing habits. What else can I buy, or what other movie may I like? Now it's about generating new content based on my interest, and you can be very descriptive. You don't have to have the exact query in. You can describe the features, and the generative AI can generate an image, a video, or text, or whatever. So that's the big difference.
So for these 16 to 34-year-olds, of which all three of us are none of those, how are they using it?
Well, so I think the use case was initially around search and can you help write my essay or, just anything that kids may do, in terms of tinkering with new technology. And I think the way it's evolving is this is becoming more of the good part of it is it can be a virtual assistant for you, a personalized virtual assistant, because some kids may be good in math, some may be good in physics. And so the AI can help you get smarter in things where you're not so good at, where you didn't understand everything in the class. And this is your personalized assistant, which is very smart. It's improving every day. And I think that's the good use case of it, where I think not only the kids, but even others may find it to be useful. And I think everybody would say they need a personalized virtual assistant. Siri didn't prove to be one, but if you help really make it smart, I think you can see that use case of generative AI.
How about for search? Is this an issue for Google?
It is definitely
a risk for Google. I'd put it
absolutely. Given Google's market share, which is over 90%, anytime you have an incumbent with such high market share and there is a disruptive technology, even though I would argue Google still has the best ad stack, their ad pricing will always be higher than above. But with 90% plus market share, and that's what Microsoft said initially with the launch of, the integration they did with ChatGPT is even if we take 1 or 2% share, it's going to hurt Google. And so Google has a tough task at hand. They're developing their own large language model. So they're obviously competing with ChatGPT in terms of, how that foundational model can work in terms of the quality of the output, because that's what people will compare it against.
So gaming it out, if I'm an AI company, how do I make money? I mean, the way you're talking about it is through search. So then is it ad sales?
I still think, and our survey work actually validates that even though the 16 to 34-year-olds like using it, they want to be the freemium user. They don't want to pay $20 subscription a month. The propensity to pay is like the cap is around $10. And after that, it really falls down from there. But the point being that sponsored ads will still be the way. And actually, Google showed a demo of the next version of their search page. at the I/O event where they said if somebody searched and they wanted to do a follow-up, they can show a follow-up button. It retains the context and it makes it seamless in terms of, how you do follow-up searches. So that is where you can layer in, sponsored ads, and you can really enhance that experience with generative AI, where you're not just clicking on blue links, and that's not how Google is making money, but it can be more intuitive in terms of how you do, follow-up searches.
How about intellectual property, safety issues, regulatory issues? I mean, it feels like we are on the wild west here, and we have no idea what we have here.
Yeah, and DC moves really fast with these things. Yes.
Well, so think of how these large foundational language models are being trained. It's open internet, whatever is on Reddit, whatever is on social media out there, if it's exposed through APIs. And that is where it gets tricky, because some of the data that's going into large language models, we're talking about, 100 billion parameters. Well, some of the data could be IP of a company that just happens to get exposed, and now the model has been trained, and there is no way to undo that training that has already happened. So I do think, and in our survey work also, 40% of the respondents said they didn't want to use it because of IP issues. So clearly that could potentially be an issue, and companies are getting sensitive about what they expose in the form of APIs. But I think that doesn't mean the technology will, stop developing.
If I were to say, hey, write me a 300-word essay on George Washington, isn't the internet, for lack of a better word, just going to go lift some text from a book on George Washington?
It could, but it has got so many sources, and to come up with a smart way to actually tie everything together, like this is like how we are interacting. Okay. So the large language models is basically training on, human intelligence, human level interaction, and they can do that,
Which no doubt is amazing.
Yes.
And that's also why, I think there was a chart I saw about the amount of times AI was mentioned in earnings calls, and how it shot up. And you could even look at Wendy's when they talked about AI in their conference call, their stock shot up. Yeah. And you can see that reflected in some of the valuations, because even NVIDIA that has the special chip that goes into the thing for the AI. Yeah. How do we know what the proper value of this is for a company?
Well, so I think clearly valuation is a separate discussion in terms of what's already baked in terms of future growth. But the point being, it was the same thing with internet. 99, you talk about when you look at multiples, they were absurd. But at the same time, Amazon continued to grow. The fundamentals were strong, and you saw that in top line growth. Now, what does that translate into in terms of stock returns? Probably not much. And so that is where the euphoria will always be there at the onset, and this time will be no different.
Mm-hmm.
All right. If I want to invest in this, is there an AI.com or something, or do I just go by Microsoft? I mean, how are people trying to play this, which a lot of smart people are saying, think internet, and before internet, post-internet. People are kind of saying that about this. I'm not sure if I go there, but if that's in fact the case, how do I play it?
I mean, software is always a safe bet. And right now, everyone is focused on the first derivative impact. Okay, you need the chips to do AI. But then the applications will come, the software will come. And really, the sticky part will be the software, because that's when you have a recurring revenue business. With chips, yes, they will do very well, but it's still cyclical. And so that's one aspect of it.
So just to round out the conversation in terms of the survey that you did, what was another standout that you learned from the survey?
Well, so the other aspect of it was foundational models versus apps. And I think a lot of people realized ChatGPT is clearly associated with generative AI, but the apps or the functionality that could evolve could be much broader. And they are interested in trying that out. But right now, all the buzz is around ChatGPT and, where all it's associated. So clearly there is interest, but people don't know where else they can try, generative AI, because ChatGPT and generative AI right now are synonymous, and that's definitely not the case. So
ChatGPT, do you use it?
I do. I am a ChatGPT Plus user. I pay $20 a month.
Look at you, big guy.
I mean, does he have to?
Now, how do I get this? Do I go to Where do I get this?
So-
Dude, you just started using PayPal.
Yes, exactly. Am I ahead of myself here? All right, we'll talk about this.
Yeah.
But all right, we'll see. I can go where the kids go. Yeah, absolutely. Mandeep Singh, he's the senior tech analyst for Bloomberg Intelligence.
I just figure one day my daughter will just teach me. All right,
Yes.
coming up on the program, we're going to talk regional banks as loan losses loom.
You're listening to Bloomberg Intelligence on Bloomberg Radio, providing in-depth research and data on 2,000 companies in 130 industries. You can access Bloomberg Intelligence via BI Go on the terminal. I'm Paul Sweeney.
And I'm Alex Steele, and this is Bloomberg.
You're listening to the Bloomberg Intelligence Podcast. Catch the program Saturdays at noon Eastern on Bloomberg Radio, the TuneIn app, Bloomberg.com, and the Bloomberg Business app. You can also listen live on Amazon Alexa from our flagship New York station. Just say, Alexa, play Bloomberg 1130.
All right, we'll be here each and every week at this time, tapping into our Bloomberg Intelligence analysts covering some 2,000 companies in 130 industries worldwide.
Tell me if you heard this one before, regional banks and problems there. Okay, asset quality has yet to suffer despite some signs of credit deterioration in some areas, and then you have tightening conditions that could soon translate into higher loan losses. It's like a triple perfect storm, something like that. For more, Bloomberg Intelligence senior U.S. regional banks analyst Herman Chan. Herman, you told me months ago that this was your 2 minutes of fame. Your 2 minutes of fame has been like hours and days.
It's been extended a bit, yeah.
It's been extended. Are we past the interest rate crisis for regional banks, and then are we coming up on the credit crunch crisis? Let's just set the stage that way.
Yeah, sure. I think the liquidity issues that felled First Republic and SVB, I think we can safely assume that across the industry, we haven't seen further repercussions on that front. PacWest has seen some deposit outflow, but by and large, for the regionals that I cover, we haven't seen any further deterioration in deposits or liquidity. So that's great. But there is some headwinds on the fundamentals for regional banks, and one of them will be asset quality going forward, where if the expectation is a recession is coming and that will portend higher credit losses for banks. And one of the big issues is office commercial real estate that's guaranteed to offer some higher losses ahead. But overall, it seems like the losses will be fairly manageable for the group.
All right, Herman, I got a great new idea for a business. So I go down to my local bank. The guy, the banker there, the loan officer is a buddy of mine. We play poker.
Yep.
Am I going to get that loan to start that new business?
You might get that loan, but you're going to have to pay up for it. And you might have to maybe not get as big of a loan that you may have been expecting. So we've seen across the group that credit is tightening. And JP Morgan actually just talked about it recently in their investor day where they're surgically tightening credit. We've seen that from the Federal Reserve's survey that they do every quarter where they survey banks. And they've talked about tightening credit across all different types of loans, from credit cards to commercial real estate, commercial loans, home loans. So it's happening across the group because of a number of factors. One, deposit costs are rising after the SVB debacle. Banks are paying up to retain those deposits. Two, banks don't want to add more loans to their balance sheet at this point because they're conserving capital. They know regulations are going to be tighter and the regulators will force more higher capital ratios on them. So they're running that as well. So there's just less lending across the board.
For the loans on their books, is it just a matter of commercial real estate is going to be a rough spot, or are there other areas?
Yeah, I think commercial real estate's front and center, particularly in office. But you'd expect loan losses across the board. They're still actually pretty low relative to historical standards and even versus the pre-crisis period. So at this point, we're not seeing any credit stress, but the expectation is we'll see some higher loan losses going forward. And some of the early indicators that we track, something called criticized loans, which is like a early warning sign of potential losses, that picked up in the first quarter.
There's more than 4,000 regional banks in the United States. A, do we need that many? And B, if we don't, does that mean we're going to have some consolidation coming up?
Yeah, 4,000 is a lot. We'd expect more consolidation over time, and that's happened over the years. Banks need to compete with the largest institutions like JP Morgan and Bank of America that are investing so much money across the board in everything that they touch. And you have to compete with the fintechs as well. So scale is key, and you've seen that as banks continue to add more scale by partnering up. So that's something that should happen over time.
Okay. That totally makes sense. However, regulators have not liked that.
Right.
What I find so weird or bananas about what happened with First Republic and JP Morgan is like they wouldn't have probably let JP Morgan buy First Republic before it failed, but then it failed, and then therefore it can buy First Republic with a nice little, cushion from the government. They're not going to let two regionals buy each other now, are they?
What we've heard from the Treasury Department, and Janet Yellen recently said that they'd be more open to deals. Prior to this whole banking turmoil, both the administration and the regulators had a very dim view of consolidation, particularly with larger regionals. And you've seen that with some of the recent deals that took much longer than expected to get regulatory approval, and also the recent deal with TD and First Horizon. That one just went by the wayside because the regulators wouldn't approve that one. So it's something that I think the administration and the regulators need to reconsider, and I think they are at this point. So potentially that should open up the window for more M&A.
Are we seeing the banks? I mean, this recession has been the most talked about recession of all time, when and if it actually happens. But if I'm a banker, does that mean for the last 3, 4, 5 quarters I've been increasing my reserves because I keep reading about a recession coming?
Yes.
In which case it won't be that bad when it comes, kind
right.
of thing? Yeah.
Yeah, that actually has happened. So each of the banks, each quarter they take a look at their reserves and think about the potential changes in the economy as a macro overlay to how they reserve. So those reserves have gone up over the recent quarters, and actually it could pretend that banks may not have to add that much more to reserves because, A, the loans aren't growing anymore, so you're not going to add reserves on those to account for that. And they've already built up to a certain extent, so future reserve building may be less going forward.
Which banks are still vulnerable? And if you don't want to say the names, give us the qualifiers.
The banks that are still vulnerable are the ones that really could see some further deposit outflow. As we've seen, if any bank shows that deposits are declining, the equity market reacts just so viscerally to it. So that's something that I think is not going to go away anytime soon. And the other risk is that if we see an unexpected rise in charge-offs, that could also bring down the industry to another level going forward.
Well, Alex, he's got Herman and his team's got a great chart in his recent research report, office exposure in focus. So as a percentage of total loans and loan to value,
that's a lot.
Boy, that screens. So there's some, Bank OZK, I'm guessing that's Bank of the Ozarks,
right.
Citizens Banks, Comerica, all pretty interesting there. So there's a lot of names out there that have some exposure, but not crazy exposure.
Right. And Bank OZK is the biggest exposure with respect to office CRE.
Great stuff. Herman, you're the best. Herman Chan, Bloomberg Intelligence Senior U.S. Regional Banks Analyst. All right, now let's turn to U.S. cable and satellite space. There's concern around a recent broadband slowdown that could put pressure on the industry. Let's get more with Geetha Ranganathan, Bloomberg Intelligence media analyst. Do we have a broadband slowdown? I thought we were going to give broadband to everyone and it was going to be the big money maker forever with 5G.
We did give broadband away to everyone during the pandemic, and that's kind of what has created this problem that we have now for the cable companies. So we're talking mainly about the two largest cable providers in the United States, which are also the two largest internet connectivity providers, Comcast and Charter. Together, they have about 61, 62 million subscribers across the United States, but they've really seen their growth come to a screeching halt over the past few quarters, and it doesn't look like it's going to get much better through the rest of 2023.
So what is the cable bull story now, Geetha? I have a hard time finding one. If I want to look at a Charter, for example, what am I hanging my hat on if I buy Charter?
So they've really kind of now shifted the broadband narrative away from just subscriber growth. And Paul, we've seen this in the streaming world as well. Yep. Now it's becoming ARPU growth. And they're really kind of hanging their hat now on being able to grow revenue at a fairly stable pace. So even though we're not seeing any broadband subscriber growth, they're banking on pricing power given the superiority of their product. And so what we're looking at is about 5 to 6% broadband ARPU gains driving EBITDA growth in the future.
So how do others then compete with that?
So, what really has been the cable problem over the past few quarters has been this tremendous growth in what is called fixed wireless access. So instead of, the last mile connection now is basically through 5G, is basically through, radio waves or through airwaves rather than through, a copper or a fiber optic cable. Very easy to kind of hook up, and it has been priced very, very competitively by both T-Mo as well as Verizon. So they're pricing their fixed wireless access, which they call 5G Home, at about $50 a month. Compare that to a cable product which sells for about $75 a month. So all of these dissatisfied, disgruntled cable customers have obviously jumped ship. The problem is at some point, the fixed wireless product is inherently an inferior product. So at some point, the service is going to start to buckle under the stress just because of congestion issues. And so that's kind of what cable is banking on. So, customers will eventually have to come back just because they have a superior offering.
So what's the status of the cable bundle, which worked so well for so long, Geetha, with I could get video, I could get broadband, and now even wireless? Is that still a competitive advantage?
Yes, bundling still does help them both acquire and retain customers, but the constituents of the bundle have now shifted. So as you pointed out, Paul, that obviously pay TV was a huge component of it. They no longer really care about the video portion of the business just because the margins are not attractive anymore. So if you look at a video package, for instance, it brings in about 13 to 14% margins versus broadband, which gets them about 70% margins. So they have realized that, cord cutting actually, as counterintuitive as this seems, actually, as more people leave the cable bundle, it's actually working well for their margin story. And so they no longer are really incented to hold on to the video customers, but they are using bundles. They are using bundles now, especially with the wireless product, and even with more skinnier kind of TV packages. So Comcast recently announced what they call Now TV, where they are now offering like a lineup of TV channels for $20. So they are trying to woo the customer. They're just doing bundling and packaging in a very different way.
Well, to your point, like when we cut the cord years ago, I shaved some off my bill, but I'm really paying for the Wi-Fi. That's really what I'm shelling out my money for. Going back to what you just said earlier, so basically the traditional cable companies are waiting for like the T-Mobile and the Verizons to get it wrong and then scoop up those customers. That seems like a terrible business strategy. What if it doesn't go wrong, or what if Verizon and T-Mobile innovate enough to keep their service going?
So what cable is doing, now that's a great point, but cable in the meantime, they're just not sitting still. They are now undergoing their next big CapEx cycle, which is they're investing in their network. They're making sure that they are comparable to, the telecom fiber product, which, again, kind of puts them at a competitive advantage to not just fixed wireless, but also kind of makes it a level playing field with fiber. So the whole broadband landscape has always been about market share kind of shifting between the cable and the telecom operators. And so, again, we're going to continue to see this seesaw play out over the next few years as well.
Geetha, as you know, I'm a big fan of free cash flow, but I'm looking at the free cash flow of Charter, Altice, Comcast. It is nothing like it was over the past couple of years when I look forward. Are we in a big CapEx cycle here? What's causing the decline in free cash flow?
CapEx is a huge part of it, definitely, Paul. We are seeing slowing EBITDA growth. Part of that is, of course, because of this broadband subscriber slowdown. But I think most investors have now kind of digested this news that we are going to definitely see a huge rise in CapEx, especially for Charter, which is embarking on this new rural initiative. They're looking to wire up about 1 million to 1.5 million rural households, which is going to cost them about $5 to $7 billion over the next few years. So that is why, we're kind of seeing this pressure on free cash flow. But I think, investors are now really looking at 2025 as the point when, again, free cash flow starts to ramp up pretty significantly. Buybacks start to ramp up pretty significantly.
That's a lot of money to have to spend. And I'm wondering if you have higher rates, et cetera, like, does that make the cost of capital difficult? How do these companies handle it?
So what we've noticed is because there is no more M&A opportunities necessarily available in the cable space, building out your network or what they call edge outs or expansion into new territories is as good as M&A. So it's the ROI is pretty good. They've said that it's about a 19 to 20% ROI, which is really good for the cable business. And over time, this is the only way for them to kind of grow their business, because if you look at the broadband market in the U.S., it's a fairly saturated industry. We're already at about 90% penetration. So the only way is to wire up new homes.
Great stuff. Geetha, thank you so much. We love talking to you. Geetha Ranganathan, Bloomberg Intelligence media analyst. Thank you so much.
That's this week's edition of Bloomberg Intelligence on Bloomberg Radio, providing in-depth research and data on 2,000 companies and 130 industries.
And remember, you can access Bloomberg Intelligence through BI Go in the terminal. I'm Alex Steele.
And I'm Paul Sweeney. This is Bloomberg.